Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at three different companies, two in consumer discretionary, one industrials. These are companies that you guys have asked me to look at, and that's exactly what we're going to do. But before we do anything, I would like you to press that like button, subscribe to the channel, let me know if you have any questions, as well as of course join us on the Patreon account where you get access to the Discord, and you've got loads of other things in there including dividend trackers and so on. So what I want to do is I'm basically going to go over the three companies as quickly as I possibly can, give you a little bit of information. Of course, as usual, go away and do your research and make sure you know this is just for entertainment purposes. Make sure you know exactly what you're investing in, InshaAllah, moving forward. So the first company I'm going to look at today is Tractor Supply. This is a company that you guys asked me to look at. This is kind of basically retail for farmers. Okay, so they sell it to normal farmers. They sell it to, for example, ranchers and tradesmen and so on, small businesses. So they are basically the supermarket for all the farmers and so on. Currently they have 196 stock price, and in terms of EPS we're looking at about $10.25, market cap of $21.7 billion. It has a wide economic moat, and the company has a very low beta, which is quite nice. Anything below 1, that means it's not too volatile. PE currently is 19, forward PE we're looking at 19, and the 5-year average is 22.91. That tells me the company is actually undervalued at the moment. And price to free cash flow right now, we're looking at about 33. So it's actually way, this shouldn't be a percentage. Okay. So price to free cash flow, basically right now it says is 33. So it's way lower than basically what it was in the last 5 years. And right now the sector we're looking at about 22, and the S&P 500 we're looking at 24. Now, in terms of dividend, we're looking at about just over 2%, payout ratio of 38%. Latest increase was 12%, and 5-year growth rate of 29%. Dividend growth is triggers of 12 years, annual payout $4.12. Safety-wise, 68%, which is quite nice. Free cash flow right now, we're looking at absolutely crazy. Wait, free cash flow? I need to double check this because that cannot be accurate. Oh, no, it is. Basically it's less than $1 billion, so yes, it is actually somewhere here, the free cash flow. There you go. Okay, so less than $1 billion. So the free cash flow is 819 million right now, just below $1 billion. And again, when you're looking at 21 billion, almost 22 billion market cap, so that's not a surprise right there. Free cash flow yield, we're looking about 3.8, and free cash flow margin of 6%, which is absolutely fine. We're looking about more than 3%, we're looking at more than 5%, so it meets that criteria. Profit margin right now, we're looking at about 8%, operating margins of 10%, return on equity of 55% right now. And in the last 10 years, it has returned about 12% to basically shareholders. Total return, that is including dividends and so on. Return on invested capital, we're looking at about 17%. Revenue, we're looking at in the last 5 years, we're looking at about 15%. And current ratio is above 1, which means the company has enough liquid assets that they can liquidate if they need to in the next 12 months to pay off any current liabilities. Now, the other thing that we need to look at is the forward estimates. So we're looking at the in terms of EPS, about 7% growth, and then the following year, it's about following 5 years, 7% growth every single year. Current price, we've seen 196. Morningstar says their price target is basically $212. Right now, it's about fairly valued according to them. Simply Wall Street is actually 244. That means about 19% undervalued at the moment. TipRank is a price target of 218. That's about 10% upside from where it is. They're saying it's a moderate buy. Price target from Seeking Alpha is more or less the same, $215 per share, 10% upside. It is a buy according to them. From Sharia compliance side of things, it's actually fine. So 100% in terms of business activity screen, in terms of interest-bearing securities, and about 17%, and 0.82% in terms of interest-bearing securities. Interest-bearing debt is just 17%. They're buying back their own shares, which is quite nice. Okay, and actually this is quite aggressive. I like that. Okay, the company is actually increasing this dividend. It's buying back their own shares, and they have basically, I think the last 5 years they have grown almost doubled in terms of free cash flow here, and then it went back to what it was before. But right now, in the trailing 12 months, we're looking about 819 million right now. So in terms of overall, the company is actually in a very good position. They are the market leader when it comes to the products that they sell. The dividends is actually solid. It has a free cash flow. Basically the profitability side of things is good, and the fact that it's growing 7% and so on is good. This is probably the type of business I would actually add to my portfolio, and then let it be about 3% basically overall of my overall portfolio, because that's that kind of steady eddy companies that you need. But of course, make sure your entry points are very good. I'm not giving you financial advice, but I will say this, okay? Have a look at it, the company deep down, and understand it, but it looks like to me right now is undervalued a little bit. Okay, right, the next company we're looking at today is another one that you guys are asking me to look at, Genuine Parts. This company is distributed basically automotive and industrial replacement parts. It operates through the following segments: automotive parts group, industrial parts group, and corporate, and so on. This company is probably one of the oldest companies that I know. Okay, currently trading $135 per share, $4 of EPS, 295 billion market cap, which is absolutely huge. It has a wide economic moat, and beta is quite low, which is again good. Current P is 15, forward PE is about 15, 5-year average about 18. Okay, so about almost 19. So that means it's a little bit basically cheaper than where it was in the last 5 years. And price to free cash flow right now is about 25. Again, the sector is about 22. The S&P 500 is 24. Latest increase of about almost 3%. Payout ratio 41%. Latest increase. Sorry, that's the dividend yield, 2.8. The latest increase is 6.1. The 5-year growth rate of 6%. In terms of the growth streak, 66 years. So this is a dividend king. Okay, let me go back. Actually, I didn't. So 12 years. Okay, whereas this one has been increasing its dividend for 66 years, which means they are dividend king. Kings are companies that have increased their dividend over basically 50 years. Annual payout of $3.80. Safety 80%, and free cash flow right now just below $1 billion. Free cash flow yield of right now 4%, and free cash flow margin of 5%. In terms of profit margin, 5%, operating margin about 7%, return on invested capital almost 32% right now. Total return in the last 10 years, we're looking at about 7%, return on invested capital of 15%, and the revenue in terms of annual compound growth rate of 8%, and current ratio we're looking at just above 1%. They're expecting the earnings to grow about 7% next year, and then 9% after that every single year. $135 per share right now. Fair value price for Morningstar is currently $161 per share. Okay, that's about 15% discounted from where it is right now. 222, and that's almost a 38%, 39% undervalued according to Simply Wall Street. Tip rank is actually saying 154. That's about 13% upside from where it is right now. Is a moderate buy. 156 for Seeking Alpha, about 15% undervalued at the moment, and it's a buy from them as well. So again, another company that seems either very valued or basically right now and basically discounted. So it'll be interesting to do a little bit more digging and find out if you're really interested in this company. Business side of it, absolutely no problem in terms of rate compliance side of it. Interest bearing debt about 21%. Interest bearing securities about 3%. They're buying back their own shares, and basically free cash flow has actually declined tiny bit in trailing 12 months, but more or less in that 1 billion range, which is normal for these type of companies. So another solid business. The dividends are actually good. They probably will carry on paying that dividend. So it will be interesting to see, of course, to do evaluations and so on, and then find out a bit more information about the company. And again, it's one of those companies that you probably, if you wanted to own, you can limit it to 2-3% of your overall portfolio. The final company that we're going to talk about today is Parker Hannifin. This company is basically in the industrial sector. They sell all types of products. So it basically sells products in the industrials, aerospace, and basically systems as well. They have loads of different products. I actually looked at their website. I didn't even know where to start. This got so many different types. So in terms of packaging, processing, transportation, mobile construction, fridges and so on, air conditioning, agriculture, military machinery. They have anything and everything you can think of. So they sell loads of different types of products. Currently has a price of $420 per share, EPS about $18 right now, market cap of 53, let's call it about $54 billion right now. In terms of the moat, is a narrow moat right now, and it seems a little bit volatile, 1.459%, not 9, sorry. And PE right now we'll be looking about 23%. The forward PE, so PE right now is 23 and the forward PE is 18. The 5-year average is about 17. So that tells me again it might be a little bit discounted right now based on the historic multiples. Again, the sector is about 20 and the S&P is about 24. Price to free cash flow right now is about 19. So again, seems a little bit expensive when you look at the price to free cash flow, but based on the 5-year average, it seems a little bit basically cheap right now, expensive right now. Okay, forward P being 18 and the 5-year average about 17, so it's a little bit pricey according to that. Now in terms of dividend, 1.42 payout ratio, 25%, 11% increase in the latest increase. The 5-year growth rate about 15%, 67 years of increase in that dividend, so that means they are a dividend king. $5.92 is what you will get annually. If you haven't liked the video by now, please do so. It really genuinely helps the channel, and I'm absolutely exhausted. Just came back from work not long ago and I'm doing this just because I genuinely want to share my thoughts on these things, and just of course I like to keep posting as much as I can. So it would be really helpful if you can join us on the Patreon account, as well as of course liking the video and subscribe to the channel if you haven't already. Dividend safety, we're looking at about 94% right now. Free cash flow, we're looking at about $2.6 billion of free cash flow, which is quite healthy, but it's a huge company in comparison to the two other companies that we've seen right now. Okay, slightly smaller. Free cash flow right now, you were looking at about 5%, and the free cash flow margin of 14%, which is really good. Profit margin about 12%, 18% of operating margins. Return on equity 24%. Total return the last 10 years, we're looking at about 15%. Return on invested capital of 12%. In terms of revenue, we're looking at about 5% in the last 5 years. A compounded annual growth rate of 5%. Current ratio just below 1%, so we're just below 1, so that's not bad at all. Current ratio, I can't even talk. Growth estimate for the next year with basically 10%. Growth estimate for the next 5 years about 11%, and current price is 420. The Morningstar expects the price to be about 400. The fair value of 411, so it's not far off. So that's a fairly valued right now. Fair value for Simply Wall Street is 569, so that's about 26% undervalued according to them. Tip rank 474, 13% upside from where we are now, and it's a strong buy. Seeking Alpha $455 right now, 8%, 9% upside from where we are is a buy from them. Now, according to Sharia compliance side of things, in Zoya, it's saying about almost 100% in terms of business side of it, 25% in terms of interest-bearing debt, and 0.97 in terms of interest-bearing securities. They are buying back their own shares, and basically in terms of free cash flow, as you can see, is actually heading in the right direction and is increasing every single year. So we'll see what the trailing 12 months tells us. Now, I'll be honest with you, out of all of the 3 that we looked at today, I like Tractor Supply. Okay, it looks good. If I needed basically a consumer discretion in a company, I'll probably buy this one and basically hold about 3% of the portfolio. I also like this one here, Parker Hannifin, but the only issue that I have is the interest-bearing debt. So this can easily, if the market comes back quite down, and then that could actually be affected and so on. But at the same time, it seems a solid business. The growth is actually there. It seems a little bit discounted right now. So with a margin of safety, you might actually get a good entry and so on. So I like the 3 companies. They all have different things going on for them. But for me, I'll be more interested in the first one, Tractor Supply or Parker Hannifin. So let me quickly show you one last thing, okay, and that is the revenue growth side of it, because it would be good to know that. So as you can see from here, 14 points. So this is Tractor Supply, so that's the first company. So as you can see, it's heading the right direction. So from 14.2 to 14.6, and then 15 from there onwards. And then the next one is exactly the same. So basically it's heading the right direction. Now the next company that we need to look at, genuine parts company, and again similar thing, is heading the right direction. If we just change this to annually, so you can see it's also they're heading to the right direction. The reason we're looking at these things is very important, because if the company is not making money, is the revenue are not growing, basically, then you're going to face a lot of issues. And what's the point of buying companies that are not going to grow their revenue year after year? So from 19 to 19.9 in terms of EPS, earnings per share, is also heading the right direction. So overall, that's the three companies that you guys asked me to look at. I'm absolutely exhausted, so I'm going to pause this video. Have a wonderful day. Assalamu Alaikum.